how do you? Sorry to interrupt you in the middle. Sorry, I will keep on bothering you with
No,
these
that's fine.
questions.
That's fine. Please do.
How do you judge which shape as retail and which shape as institution?
Well, it really retail that's really you don't need to worry about. All you need to worry about is where the buying and where the selling is going to be, because we can't move the market, right? We can't push the Nifty around, so we need to transact where the buyers are if we want to go long,
Okay.
and we need to transact where the sellers are if we want to go short, because we have no power to push the market down. We need somebody to come and sell from a long position to introduce supply to push prices down.
Mm-hmm.
Right. So here, this blue area is where 70% of the volume or time has been. So these people, the people who bought at say 4318, they're stuck long. Some of them will sell out.
Mm-hmm.
When they sell out, you look for this and you know that there's going to be buying down here. But if the market can't even get down to this level and then you see this double bottom, that means the supply has shut off. It's kind of strange little concepts in market profile, but what I do is I try and make it practical. So when you see a move up and then a B-shaped profile, you know that this is accumulation of this product that's trapped to be sold further at higher prices for profit.
So I have a very basic question on market profile. Sure. So let's take only one, say any profile as an example. We can go to the profile and at the bottom, the 20th. 20th of October profile. Now, this profile, does it represent one single day or?
Yes, it's they're 30-minute periods. So basically, all this is a half-hour candle chart.
Okay.
Right. All we're doing is it's a half-hour candle chart, and we can actually split the profile, right, to show you, right. So this will split the profile to show you exactly each candle, and you can see structure. The other beautiful thing about this is you know where all the stops are. So if you see this, the high of that day, that's where we took the upper stops. Short sellers would have had their stops here. So when the market comes back down to that level, you know that there are going to be bids here because the shorts are trapped. A short seller is nothing more than a future buyer. Right. So that's where we look to initiate our long, right? Then once the market looks above and comes back into a level, for example, right, we would look to take a short, but where would you cover that short? You would cover it on the break of this low right here. That's where the stops get run. And what I say is, I call this my piñata level, because if you break this level, all the candy above it falls out into these bids, right? And then, this is accumulation. They cut the supply once you accumulate, take it up to resell, right? And now you've got this sort of distribution up here, right? I'm going to put this back to...
Sorry to interrupt you again in the middle.
No problem.
What's this blue and the orange color?
Yeah,
and the
sure.
white? How are they different?
Okay. The blue is what we call the value area.
Okay.
This is where 70% of the volume has traded that day. Right? The green is outside value. This white is what we call the point of control. That's where the most time has been spent. Where the most volume has traded. Right?
Okay.
So what all this value is cost basis. Right? So this cost basis is being sold here for a profit. And being sold sideways up here. So after markets move higher, they tend to go sideways while you distribute. And then every time you get down to this area, the large traders who control supply, wholesalers, because in the US we have a wholesale system like Citadel, Virtue. These large wholesalers, they buy and sell from us. They provide liquidity, right? Then we have large traders who are prop traders who act as wholesalers, right? Now, I'm not sure in India if that's the same, but I'm pretty sure it's kind of similar.
Yeah,
right?
It's pretty much
size,
the same,
right?
Yeah.
So say I was long 100,000 contracts down here. I would be selling maybe 20,000 here and then just gently selling them here. So now the cost basis is down here, and we will sell as much as we can. They say when the ducks are quacking, feed them, right? So the ducks being people who are coming in to buy, and we're just feeding them gently. You don't oversell because that drives away the buying. And this way you just gently sell and distribute your profit up here, right? Then what happens is if more buyers come in, this is order flow principles. You're watching the order flow. If buyers are coming in, then you just cut the supply and sell at higher prices. When buying runs out, you sell the market down to your cost basis, right? And that's all trading. That's all trading is.
So if that range is a distribution range,
yeah,
then ideally after the end of distribution, price should have gone down, right?
Yes, yeah. But the thing is, we got to remember what holds markets up after you distribute. Remember, you have short positions in this market that are holding it higher because every time the market comes down here, there's a buyer.
Correct.
Because shorts are trapped under that level. So they will go and buy at that level. So anybody who knows anything about distribution and size will just stop selling at that level and the market will creep up and you can sell higher. Right? It's a beautiful thing. And any kind of charting, whether it's a candle chart or a TPO chart, it's all the same. It's just we are looking at distribution. Now, this is another software program, and I'm just going to use the 5-minute chart here. And you can use the 5-minute chart or a 1-minute chart to give you the same sort of references. So here's just a 1-minute chart of the S&P 500. Right? This is the ES futures. And here, earlier on, when London opened, we found this is a small balance range. So when we'd look above 4,006, we'd come back in, down to 4,002, back up to 4,006. So if a market's choppy or slow, I teach people to sell this, buy this, sell this. When it looks below and comes back up, then we buy because it's going to go back up to the top. When it looks above and comes back in, we sell. And if it can't get to the bottom, you cover. And then when it looks back up over it, all we do is we just take this range and double it, and you will see how you can find your target.